Let's get technical. We got a lot of charts to get through as we look at the status of the market. We saw yesterday some decent breadth and participation. 10 out of 11 sectors higher. Cyclicals did well. Maybe we're in store for a little bit more of that if we can get a sustained bounce back in the Russell this morning after some good ISM data. Let's talk breadth and more with David Keller, joining us, the Chief Market Strategist at StockCharts.com. David, good morning. Always good to have your look here at the market. Start us off from the top level and that subject of breadth that has been very puzzling when combined with just the relentlessness of the index highs. Where are we at in that situation?
Yeah, it's good to be back with you, Oliver, and I think you described it very, very well. You have the relentless uptrend, this continued push higher, and I was taught by one of my early mentors, Ralph Acampora, if you look at nothing else, look at the price of the S&P 500. That will tell you most of what you need to know to understand the trends, and it's clearly been a continued vote to the upside. Every month this year making new all-time highs. However, the breadth picture is what continues to be concerning, right? Overall, you see the advanced decline lines in the S&P 500 going higher, but all the other advanced decline lines are actually sloping downwards. You have a decent number of new highs, but you also have an increasing number of new lows on the NYSE. So you're getting this expansion of negative breadth indicators that continue to disagree with the indexes going higher. And if you follow the normal playbook for a breadth divergence, that's a lot like what the February 2020 high looked like, is where you had higher highs January into February of 2020, lower highs in a lot of the breadth indicators. And that was an indication of a lot of concerning patterns on a lot of stocks underneath the hood. So the index looks okay, but the breadth conditions tell you that the conditions underlying the uptrend are deteriorating.
It's pretty interesting to see this as new lows, because I've kind of been looking at the lack of new highs, but new lows is a different beast, right? I mean, that means that stuff's not just going up. There's a lot of stuff that's going down.
Yeah, and what's interesting about that chart that we were just looking at is that think about how far away a 52-week low is for the average stock, something like Amazon or Apple or things like this. 52-week low is a long way away for a lot of names from the strength that we've had in the last year. So the fact that you're seeing an increasing number of new lows shows you that not just certain things aren't participating, but you're actually seeing a good amount of distribution. Now, granted, these are in things like Staples and and Kraft Heinz types of charts that are really rolling over. But the reality is that's what a downtrend sort of looks like, is an expanding situation of new lows where stocks are not just unable to participate on the upside, but really starting to push to the downside. The more that grows, I think the more of a danger sign that is for, or a sign of limited upside for sure.
Now, the overall index, David, if we zoom out, you break things into short, medium, and long term. Just for looking at the S&P 500, how do each of those perspectives fare right now?
Absolutely. So I have a market trend model that I've run for years and years. It's all based on weekly data, and it uses exponential moving averages, which are a great way to just sort of simplify the trend and understand the long-term trajectory. And for me, the long term is really looking out, a year plus. And that has been, overall very, very positive. My long-term model turned positive. It's that sort of purple shaded area on the screen. Turned positive last June, so it's been over a year in the positive. And as the S&P is making new all-time highs fairly consistently, that makes sense. That's meant to capture sort of the overall secular trend, which is undeniably positive. The medium-term trend, though, is, I would argue, the main signal. And for me, it's not a systematic, am I all in or am I all in cash sort of indicator, but it's more telling me, should we be thinking more about potential return or potential risk? And my weekly model turned negative in May. And what that told me from sort of May on was, while things could be going higher in certain pockets of the market, like in healthcare and some financials, and others have been doing just fine, overall, that's telling me to think more about risk, to think about the line in the sand at which you want to take profits or get defensive on some of your positions. And that served me well on a lot of the cyclicals that have struggled and have come off. And at this point, I'm not seeing signs of negativity from a lot of technology and others that have held on just fine. The short-term model is really meant to just capture the short-term swings. And for the most part of the last 6 to 8 months, I think 2 weeks out of that last entire period, the short-term model has been negative. Overall, it's been very, very positive. So that medium-term model being negative for the last couple of months describes what I would call a stealth correction. I feel like while the S&P has been going higher, you've actually seen the characteristics of a correction, depending on which charts you look at. And certainly, I think it would behoove investors to continue to think more about downside risk, especially in the seasonally weaker part of the year that we are right in the middle of, as opposed to thinking about shooting the lights out and riding the next leg higher.
Okay, so shooting the lights out, riding the next leg higher may not be the most probabilistic thing right now, kind of based on the way things are, but it seems like really the concern you have is in that intermediate term, where the short term, you've already got just the highs, right? You've got the index behind you, but the potential for that breadth is more kind of like a rolling thing, not necessarily some damning message about long term. It's just that you have to be wary and watch your step in this moment.
I think that's a very, very good point, Oliver. And I would argue, I think, do we finish 2021 higher than where we are now? I think that's a fairly safe assessment that we would be able to do that. But what you have to remember is that we don't always just go directly from point A to point B. And, efficient markets hypothesis would tell you that is exactly what you do. You immediately go to the correct valuation based on everything that's out there. But I think the reality of the markets is very, very different. There's not a straight line movement from any point to any other point in investing. It sort of fits and starts, or what we would call impulse and corrective waves. So I think even though the end of the year is probably most likely higher than where we're at, I think the way we get there can be rocky. I think of 2010 as a good parallel to what we're seeing in 2021. 2009 and 2020 were very similar in terms of a V bottom in the first quarter into the second quarter. A lot of strength going through the second half of those years. And then 2010 was much more of a choppy sort of digestion year where you made new highs and new lows and you have a lot of volatility. And I think that's what we're seeing, even though the index, again, is moving higher. If you look at the S&P or the NASDAQ, plenty of stocks are seeing a lot of volatility, a lot of uncertainty. And I think that's where we're in a similar boat. So July, August, September, really, if you look back at market history, just look at the last 20 years. For the S&P, it's not been great. Those have tended to be some of the weaker months. So we're sort of in the summer doldrums going into the seasonally weakest part into the early fall. And I think that combined with the negative message we're getting from breadth, from momentum, and some of the charts we've looked at so far tells me to think more cautiously in the short term, but in the medium term. But then over the long term, I think there's still plenty of upside for stocks. There's no doubt about that.
So what's interesting is it seems like the deterioration that's gotten so extreme in some of these areas, number of companies hitting 52-week lows. I was talking at the top of the show about how unique yesterday was because you had all these cyclical parts of the market working. Those are the ones that have been under pressure. Reopened trades are in straight up bear markets. So it seems like the determinant of whether that medium-term bear case comes to fruition is just totally reliant on whether or not that weakness finds its way into tech. I mean, it seems like it's kind of as simple as that in the shorter term, the intermediate term.
I think you're absolutely right. I often like to find a chart that's sort of like the tell. What's the one chart you'd look at to make sense of it? I go back and forth between Amazon and Apple at this point, but Apple probably would win. I mean, if you look at the chart of Apple, it's sort of been in a clear breakout mode, right? You sort of broke above highs over the last 6 months, made a new 6-month high, sort of broke out to the upside. Now it's in a bit of what you'd call a pennant pattern, which is a little consolidation, lower highs and higher lows after the breakout. And that has to resolve one of two ways. Either buyers take control, upside momentum persists, you see a push to the upside, you break out of that short-term range that we've been in for the last week or two, and you push to new highs. I think that would be incredibly bullish and speak to the underlying strength in technology that can keep a market up, even if you see a lot of the weakness in the cyclicals, as you mentioned. But think about the alternate scenario. What if that chart resolves to the downside? You break below that sort of short-term range. Now we're back in the range we've been in for the last couple months as an alternative. You see weakness in Apple. You see stocks like Apple and Amazon, instead of breaking out and following through to the upside, they're having false breakouts and they're coming back to the sort of the middle of the range. And I think that is what allows the S&P and other indexes to come off a good deal. I would still see something like Apple is most likely a good place to hide out in that sort of environment. I think the FANG stocks tend to be good defense in that sort of scenario, as opposed to something like the cyclicals. But I think there are other places like real estate and elsewhere that I think are good opportunities to get a little defensive if you don't see charts like Apple break out, as the technical analysis 101 would most likely suggest here.
And David, one way to look at that sector breakdown, just to close on your sector quadrant, is pretty interesting. Looking at momentum, walk us through what this shows, with real estate seemingly leading and improving, or how should we read this?
Yeah, this is a beautiful visualization called the relative rotation graph, and it's literally a way to visualize the 11 S&P sectors and how they're rotating around the S&P 500, which is at the crosshairs right in the middle of the chart. Up and to the right means it's strong, and this is all based on relative performance. So up and to the right means it's outperforming on stronger momentum, and the best out of the 11 sectors by far has been real estate. And it's funny because REITs are one of those sectors that I think people love to ignore. It's not sexy. These are not names that are more, that are widely known or widely followed, but they tend to pay a decent dividend. They tend to have, in this case, great capital appreciation as well. So the charts are working. And then you also have the income component as well. So out of the 11 sectors, that's actually been the best overall trend here for the last couple months. At the bottom of that chart, by the way, you can see all the cyclicals, which are rotating down to the southwest, down to the bottom left, which really shows you the deterioration and the relative movement of those cyclical sectors. So this is all about rotation into real estate and technology, which would be the second real emerging area of strength there, and away from all the cyclicals, which I think, based on this sort of analysis, are still things you lean away from here.
Okay. Great stuff, David. Excellent perspective. Thank you for the explanation. As always, a pleasure. Thanks.
Thank you, Oliver. Take care.
Absolutely. David Keller is the Chief Market Strategist at StockCharts.com.